Aloha folks, welcome to another dividend investing video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to dive in and look at a dividend company that has been rewarding dividend investors for 31 consecutive years. The dividend growth of this company the last 20 years is 11% per year. One of the top 10 owners of this company is actually Bill Gates. So if you were invested on this company 10 years ago, your total return would have been 84%. Is it time to buy? Is there a place in your dividend portfolio for this company? So sit back, enjoy the video, grab your favorite drink, and please remember that all of this is not financial advice. This is just me sharing. And also, don't forget to hit the notification bell so you don't miss out on any of these videos that I put out. And do me a favor, hit that like button as well. With that said, let's take a look at this company. So the company I'm talking about is Ecolab. The ticker symbol is ECL. This is a company that is a provider of water, high energy technology and services. So if you look at their website, they are a global leader in offering water, hygiene, and infection prevention solutions and services that protect people and the resources vital to life. Definitely go take out a look at in their website. You can see a lot more information here. As you can see, there's also an investor tab that you can also take a look at. So I always look at the presentation, and if you're getting some more information, as you can see, based on their quarter one strong operating performance, they continue to grow sales. So the reported sales are 9%. They have doubled their OI growth, you can see from here, and then reported EPS of 82, which is at plus 37. So some of the key growth you can see right here. Reported sales 9%, organic sales 13%. You can see reported EPS, and then the diluted, and then you can see right here their double-digit growth in their institutional, industrial, healthcare, and then the other ones. So let's take a look at Simply Safe Dividend. Based on their dividend safety score, they rate it as 98, which is very safe. The dividend yield is 1.12, and then you got your market cap of 95. And then if you look down closer to the key metrics, you can see dividend streak of 31 years without a reduction. They have increased their dividend during a recession, and you got your payout ratio of 46, and then forward payout ratio 41. And then you can look at the dividend growth. You can see the last 20 years up 11%, the last 5 years 6%, and then the latest is about 4%. Then the uninterrupted dividend streak of 31 years without a reduction. You can see again an increases for the past 31 years. So that's pretty solid in my opinion. You can see the payment details. You get paid quarterly in the months of January, April, July, and October, and your annual payout is about $2.12. Ex-dividend date is at June 16, and then you get paid on July 17. And then you can see right here, maybe undervalued based on Simply Safe Dividend. You can see the dividend yield right here. It's like above the 5-year one. You can see the payout ratio is also there. Payout ratio is about 36 versus the material is about 18. 52-week range, you can see it's closer to the high. So looking more, you can see here the payout ratio. The last 12 months about 41. Forward payout ratio is about 40. Earnings per share, you can see right here, $5.21. Free cash flow per share is $5.28, and you can see right here outstanding sales, total sales, and then return on equity is about current last 12 months 16, and then return on investment capital is about 11 with the last 12 months. Moving along now to Seeking Alpha. There's based on their dividend scoreboard, you can see right here, pretty good. The dividend yield is a D, and then the dividend summary, you can see the forward yield is about 1.12, And then the 5-year growth right here is about 5.59. Dividend growth of 30 years, so that'll be 31 now. And then you can see the dividend grade right here, the last 3 months and the last you can see right here. And then if you go on the dividend estimates, you can see right here, based on their estimate, Seeking Alpha's estimates, you can see the dividend, the rate is growing, as well as the consensus yield. And then you can see here they're expecting it to rise 2025 with $2.44 from December 23 of $2.16. And then their rating right here, you can see buy and from Wall Street and the SA analysis. Moving along to tip ranks, based on their smart score, they rated as a 4, which is neutral. Something to note about here, hedge funds have decreased their shares, as well as insider transactions have sold the shares. You can see the 5-year growth is about 39%. And then based on tip ranks analysis, they rated as a hold. If we go next to CNN Business, based on their forecast, you can see the high of 215, the median 183, and then the low 165, with a rating of 8 buys, 2 outperform, and then 15 holds, and then 1 underperform. Now, sticking also to CNN Business, you can see some of the transactions that have been going on, and then the latest. And then again, what I wanted to see is the top 10 owners. You can see right here, Bill Gates. They hold about a total value over here. You can see some of the owners with their percentage bought and sold, and then the total change. Yeah. Now moving along now to the growth. So if you were to have invested on this company 10 years ago, comparing it with the S&P 500, you can see right here, your total return would be 84% versus the S&P 500 of 114. Compound annual growth rate of about 8% versus 10. And then your starting investment of 10,000 would have ended an investment of 18,000 in 8 years, versus the S&P 500 of 10,000, it would have been 21%, 21,008%. So does this mean that ELC is a bad investment? No, in my opinion, it just shows that at that point, at that time, investing in the S&P 500 gave a better result, but you still would have had a total return of 84%. So that's just something to look at. And then if you look at BarChart, you can see, based on their analysis, they rated as a buy for the past 3 months. And then you can break it down. Currently, you can see 5 strong buy, 1 moderate sell, 11 hold, and then 1 moderate buy. Sticking along to BarChart, you can see technical analysis opinion. You can see 100% strong buy. This is the chart for the past 6 months. And then if you look down to the performance, you can see the 52-week range. It's been up 15%. The last 3 months, it's up 14%, and then the month is up 4%. And then if you look over here on this side, you can see the related stocks in there and the performance. And then the key turning points in here. So if you want to take a look at the resistance points and the level of support, so those are the things you need to pay attention at. And then looking at Alpha Smart, you can see, based on their intrinsic value, they feel that it's overvalued. And then if you look at some of the key points over here, you can see positive revenue growth about 3%. You can do positive average ROE about 7%, positive net income, you can see right here, and some other stuff here. Looking at the fundamentals, you can see the revenue, has been up 2%. You can see right here, yeah, growth of 3%, and then the average right here. Looking at the revenue, you can see 2%. You can see the net income is about 1.2 billion. Operating cash flow is 1.8 billion. Free cash flow is 1.1 billion. And then you can see the balance sheet of assets of 21 billion versus the liabilities of 13 billion. And then you can see the efficiency, gross margin, operating, ROIC, ROIA, and then the fundamental score. So that's pretty much it, guys. So what my take of this company is, it is a solid company. You definitely want to do more research if this is a company that you want to invest on. Personally, for me, I need to do a little bit more research, in my opinion, to go if I wanted this company in part of my portfolio. But I think if it's a solid company, but for me, it's just not. I don't. I'd rather invest on another company, but it doesn't mean that it might not work for you. So that's why it's important that you get these companies that you feel that it is right for your portfolio. So thank you so much for watching. Hope you like this video. Please also check out the other videos as well. Stay cool, keep investing, and I'll catch you guys in the next video. Right, take care.